Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Today we're talking about something that's exceptionally timely, and that is the direction of large cap banks. This is very important right now because in previous days we've had some big issues pop up, a big bailout package. We've got all kinds of things going. So today, the recording of this podcast is on March 17th, 2023, just in case anything changes. I am very pleased to introduce you all to Gerard Cassidy, who's a managing director. He's the head of U.S. Bank Equity Strategy, and he's large cap bank analyst with RBC Capital Managements. Now, Gerard was previously a managing director of equity research with Tucker Anthony Sutro Capital Markets. Gerard is also, and this is very timely, the creator of the Texas ratio. That's a ratio that can be used by investors to determine whether a bank could be insolvent. He earned his bachelor's degree from the University of Maine and his MBA from St. John's University. He also endowed the Gerard S. Cassidy Capital Markets Laboratory at the University of Maine School of Business. So Gerard, couldn't be happier for you to be here talking to the members right now. An awful lot is happening. Could we start off with your thoughts on the U.S. bank sector as a whole right now?
Sure, Rob. Thank you for having me on the program. The outlook for the U.S. banking sector is very fast-moving and changing. If we would have held this podcast 10 days ago, where our discussions would be materially different than what we're likely to talk about today.
Mm-hmm.
As we all know, there was two very meaningful bank failures last weekend with Silicon Valley Bank and Signature Bank. These two banks were very different than the mainstream bank that we all think of, whether it's Bank America or a regional bank like PNC Financial. These companies both concentrated their deposit mix with large depositors, which turned out obviously to be very risky. And it's been 15 years, Rob, that investors have had to look at the right side of a bank's balance sheet. And what we've seen over the years is that that's the real value for a bank. But with rates being so low post-financial crisis, with the exception of 2018 when the Fed funds rate went up to just over 2%, banks have had, and the industry has had very low interest rates to work with. And it really didn't show the strength of the franchise of consumer deposits.
Right.
We have been talking about this with our clients now for about a year, and our focus has been more on the low cost. Little do we know, not only is it important to have them for low cost, but in a time of deposit flight, they're very important. So the outlook today is a little bit different. We think we're going to get through this deposit flight that has started with Silicon Valley and Signature Bank, spread to a few other banks. We saw the discount window borrowings at a record level yesterday, over $150 billion, close to $156 billion.
Yeah.
We also saw federal home loan bank advances at record levels. So clearly, there's been a real shift in the deposit side of the industry as larger banks like a JP Morgan Chase or a Bank America have absorbed some of these deposits from the smaller banks, as large depositors obviously have angst. They're nervous, but we think as each day, each week goes by, that will calm down because the industry is very healthy aside from this issue that has flared up. And when I say healthy, profitability is good. Credit quality is incredibly strong right now.
Mm-hmm. Yep.
And so when we see first quarter results, it's going to be really important for a number of reasons, most importantly, just where the deposit levels are. So the outlook today is one of mixed signals. I don't think you can come out, ragingly bullish or bearish for that matter. We really just need to see this deposit issue calm down, cooler heads prevail, which I think will happen, and then we'll get back to the way banking should be for the rest of the year, which is modest loan growth, margins now probably cresting right now, maybe coming in, credit remaining healthy, and decent earnings growth as well as dividend growth for 2023.
Okay. Well, one thing that I think that has been very interesting is there's been this tale of two cities, if you will. The G-SIBs are in one city, and the smaller banks are in one other. So, and I presume that your outlook is basically focused on the GSIBs.
It's for the GSIBs, but also the regionals, Rob. So, there's a lot of discussion about the smaller banks. We've called a number of banks this week to check in on them. And believe it or not, outside of the worlds you and I live in, the regular middle America is not really being impacted by what's going on in Northern California or here in New York City. And so as a result, I think what we're going to be pleasantly surprised with is that the regional banks and the smaller regional banks really have not seen it much in terms of deposit outflow. And if that proves to be the case, it will be very reassuring to investors that they can buy regional banks, they can buy bigger regional banks, and all the business is not going to, our large universal banks, even though they have certainly seen an inflow of deposits, no doubt about it. But I think we're going to see things calm down, especially if there's no activity this coming weekend of other banks that could fail. Assuming there aren't any, I think next week it will be a much better week than it was this week.
Okay. These types of events sometimes lead to greater scrutiny on all banks. Do you reckon that's going to happen this time? Will there be some level of state or federal intervention or even international intervention from maybe the EU or FINRA, a place like that?
Absolutely. I think unequivocally we are going to see more bank regulation as a result of this. I think what you're going to see is there has to be better supervisory approach to looking at the issues that conflicted with Silicon Valley and Signature. When you think about what happened, they essentially were long duration assets.
Yes.
And they funded it with short duration liabilities. And that mismatch in a rising interest rate environment unfortunately destroyed the franchises.
Right.
And if the regulators maybe looked at it more carefully, and it's not to blame the regulators, management's also for blame here as well. And there'll be a lot of finger pointing when it's all over. There's no one person. But what happened was the concentration of those high uninsured deposits. The typical regional bank in the United States will have approximately 35 to 45% of its deposits in what we deem consumer categories, less than $250,000, which of course is the insurance limit.
Right.
Silicon Valley,
right.
Correct. Silicon Valley had 2.5% of its deposits there, and Signature was about the same. So it's not that I think the regulators are going to prevent that, but there has to be some sort of added capital charges or added liquidity to higher risk funding. On the same thing on the duration side for assets, if you're going to go out and have long duration assets in the bond portfolio specifically, which is where the problems were, of course, I think you also are going to need some capital charges. And then on top of all of this, the regional banks are probably going to be required to carry more liquidity.
Okay.
They may be required to take the unrealized losses in their available for sale portfolio through their regulatory capital, which is not required, but it is required for our biggest banks. So the bottom line is, yes, I think you're going to see more regulatory scrutiny, higher costs for the banks, and that will result, unfortunately, in lower profitability for the group over the it's not in the next 30 days, but over the next 12 to 24 months.
Right. And some of that is the composition of the legislature, et cetera, around that timing.
Yes, that's correct.
Yeah. So, and there's some uncertainty in that in the near term also. So,
correct.
This is a difficult question, but it sounds like you've been on the phone with a lot of these organizations. Do you believe that these pressures could reach other banks, outside of banks that had such a low number of insured accounts and those that were prone to this sort of interest rate based mismatch? Are there other risks out there related to this, or do you reckon this is the end of it?
I think we're coming to the end of it. There might be one or two others, but why I say we should be coming to the end of it is on Sunday night when the Federal Reserve put out their new policy on short-term lending, where if banks are having difficulty in keeping their deposits, they can tap the new line that the Fed has put out there and put the securities portfolio as collateral at par value. And so to me, any bank that is incurring higher than normal deposit runoff not only has the discount window at the Fed to use, their Federal Home Loan Bank advances to use, but now they have another line availability at the Fed. So they're really, for the specific reason of a deposit run, you're unable to fund it, you sell assets at a loss, which is what happened here at Silicon Valley. That process or that problem has been solved by the lines of credit that have been established, the new one as well as existing. So for that specific reason, boy, I'd be really surprised if we see another failure. We shouldn't, because strategies have been put in place to prevent it from happening.
Yep, great. Now, one of the things that I'm exceptionally also curious about is how the bank issues could lead to pressure in parts of the real economy. Not only as they are principal, but as any good CFA Society New York member knows, most changes like that are on the margin. So do you anticipate any kind of move around there to the real economy, whether it's construction or something like that?
I would say that there is certainly the risk of tighter lending standards, as well as potentially more aggressive deposit gathering with higher interest rates.
Okay.
So on the real economy, if the banks are increasingly nervous about their business, their funding structure, they may choose to pull back until all the dust settles and they have a much clearer picture of the future. So there's that possibility. But I think with the economy slowing due to the fact that the Fed's, implementing monetary tightening to slow the economy to, of course, take down inflation, we anticipate, and even prior to this situation with Silicon Valley, we were anticipating loan growth was going to slow this year from about 10% last year for the industry. And so we were thinking it'll come down to the 2 to 4 or 3 to 5% range on a year-over-year basis for 23 over 22. Well, that's, I think, more likely now. But the other side of the equation is the funding costs. With this, banks may be forced to raise deposit rates a little faster than they were expecting to keep some of these high, above $250,000 accounts satisfied, and then to keep them in-house.
Interesting. Fascinating. Okay. Do you have any other thoughts about that in a broader impact around the economy?
It'll be interesting to see if it impacts what the Fed is going to do next week. As you know, they're meeting next week at their regularly scheduled meeting, and prior to the Silicon Valley debacle, there was a high likelihood that interest rates were going to be lifted again. It is a debate whether it's going to be 25 or 50 basis points. That is not, the money. It's not in the money that that's going to happen this time. It still very well may, but the futures are more skeptical that it will be happening. So from a real world situation, having the Fed pause on its fight of inflation because of this could have longer term ramifications for monetary policy. So we'll have to see what they do next week.
Yeah, I think that is going to be keenly interesting because the most of the job reports since the last Fed rise were pretty positive. So
yeah,
it's I do not envy their jobs right now. It is not easy.
No, I'm with you. They are stuck between the proverbial rock and a hard place.
Oh yeah, it's rough. It's rough. All right. Well, Gerard, let's leave it there. Thank you very much. This has been a wonderful injection of some sober and very experienced views. So thank you for being here.
You're very welcome. Thank you for inviting me, Rob.
And thank you all for listening to this latest episode of CFA Society New York's podcast, Compound Insights. Until next time, I'm your host, Rob Rowan.